There is no way that the Fed is going to reach its target of 2% on the CPI, and we are headed towards a new round of consumer price inflation, which will make rate cuts very, very difficult. But they will have to happen anyway because we are at the verge of a financial crisis in the plumbing, as I showed you in the reverse repos, and because of the Bank Term Funding Program, especially if it closes, we're going to be in a combination of a highly inflationary environment with a financial crisis, which is going to force printing of ungodly amounts of money, even as consumer prices are continuing to rise. And what do you think happens to gold and silver in that scenario? We have a late 1970s, 1980 scenario.
Don't forget to subscribe, crypto traders. Let's continue with the interview and the analysis of this one.
This is from the Wall Street Journal, which I uncovered today. It says goodbye to the Fed's 2023 crisis facility, the BTFP, the Bank Term Funding Program. In other words, the Regional Bank Bailout Program. We're going to get into the details here. These details are going to be pretty scary once you understand what they mean if this guy is serious in ending the program. So the first two paragraphs here, it says a top Fed official on Tuesday signaled that an emergency lending program set up to counter the fallout from the failure of Silicon Valley Bank, really to counter the fallout from the Fed's raising interest rates, would likely wind down as scheduled in mid-March. Michael Barr, the Fed's vice chairman for banking supervision, suggested the Bank Term Funding Program would not be extended.
The Fed is currently facing challenges in achieving its target inflation rate of 2% as measured by the Consumer Price Index. Despite efforts, it appears unlikely that this goal will be reached. There are expectations of a new round of consumer price inflation, indicating a potential economic shift. Anticipating this, the Fed faces a dilemma. While rate cuts could be a useful tool to navigate economic challenges, implementing them is proving difficult. The looming specter of an impending financial crisis necessitates decisive action, even if it means employing unconventional measures. One area of concern highlighted by Rafi Farber is the evidence of this crisis, particularly observed in the reverse repos and the Bank Term Funding Program. These indicators point towards potential disruptions in the financial system, demanding attention and strategic interventions from the Fed to mitigate the impact on the broader economy.
So what happens then? What happens if this wonderful program is not extended beyond March? Well, I'll show you a very simple graph, which will show us the magnitude of what is being suggested here. We've all seen this before. This is the Fed's balance sheet. Here's the repocalypse, September 2019, going up a little bit. And here's the COVID lockdown insanity. And we went pretty much vertical here. And then we were slowly moving up and up and up until around the end of the middle of 2022. And we're starting to do QT. Oh, here's the first problem. Look at that. Just after a little bit of QT, you have this is the BTFP. This is the effect on the balance sheet. What happens is the Fed takes in these underwater bonds onto its balance sheet. Its balance sheet rises. And the banks that took advantage of this, that gave the Fed these assets represented by this bump here from 8.34 trillion to 8.73 trillion. So what's that, like $400 billion or something? What's 8.3? Quick math, 8.3 to 8.7. Yeah. $400 billion at least. It's going to be more than that because remember, this is fighting the other QTs and other sectors of the Fed's balance sheet. So let's say, I don't know, like $500 billion, something around $500 billion. That is the Bank Term Funding Program. I could go into the exact chart, but whatever. Let's just estimate it. If we're off by 100 billion, who really cares? So if this program gets shut down in March and they are 1-year loans for face value of underwater bonds, then what happens is that the banks that took these bonds between the dates of March 8th, 2023 and March 22, 2023, they have to pay those loans back by March 8th, 2024 and March 22, 2024 because it's a 1-year loan. So in March, these banks, if the program is not extended, are going to have to pay back $500 billion in loans and shrink the Fed's balance sheet. When you pay money to the Fed, right? When you pay back a Fed loan, the money, the dollars goes to the Fed. The dollars go to the Fed, and then the Fed takes those dollars out of existence. So if the BTFP is not extended, that is the effect of the equivalent of QT of about $500 billion by March 22nd. Is the financial plumbing going to be able to take that? I don't think so. So I'm pretty sure the BTFP, one way or another, is going to be extended. One more thing I wanted to point out about this chart. I began it over here, January 17th, January 24th, 2018. This was the first QT before the repocalypse of September 2019. So we have here, this was the peak of the balance sheet until then, about $4.44 trillion. And then they executed quantitative tightening until about September 11th, 2019 at $3.77 trillion. And then all of a sudden the repocalypse hit.
Closing the Bank Term Funding Program would trigger a decrease in the Federal Reserve's balance sheet. As banks repay loans extended during the program, the balance sheet shrinks. This reduction can pose challenges for the intricate financial plumbing that underpins the economy. When banks return borrowed funds, the money supply in the economy contracts. This can affect liquidity and potentially lead to disruptions in financial markets. The interconnections within the financial system may struggle to smoothly accommodate this reduction in the Fed's balance sheet, potentially causing adverse effects on overall economic stability. In essence, the closure of the BTFP and the subsequent repayment of loans by banks have a direct impact on the Federal Reserve's balance sheet. The ripple effects through the financial plumbing of the economy emphasize the delicate balance required in managing such financial maneuvers to ensure stability and avoid unintended consequences.
Interest rates skyrocketed to 10%, and they had to print more money. So the length from here, January 2018 to September 2019, is about, what is that? About 20 months? Well, if we look at the length of the current QT, right, we had the balance sheet peak around here, May 2022, and we are now QTing until the end of 2023, so that makes the calculation easy. It's about 19 months. It's about the same length, almost the same length as this QT until we hit a repocalypse over here. So judging by that history, we're pretty damn close. We're about a month or two away from something happening in the plumbing, maybe even less. Now, if we go to the next tab, we'll see that the reverse repos, if we zoom into a 1 year chart here, we can see that the RRPs, the reverse repos, the spare dollars in the tank that were printed in 2020 and 2021 are down to $626 billion. So we got about a month until these zero out, because as the Treasury sucks up money to fund the deficit, they take it mostly from this facility. We've got about a month left. And we've also got about a month, or maybe, 2 months left until the BTFP, those loans have to be called in. So it could be that somewhere around March, at the time where the Bank Term Funding Program, the regional bank bailout, loans have to be paid back, as well as the reverse repos falling to zero at the same time. It's going to be a rough March, people. This article from Yahoo, Bloomberg syndicated by Yahoo, the bond market rally is overlooking a soaring $2 trillion debt problem. Well, they're underestimating that problem by about half. It's really a $4 trillion. Out of the tabs for a second, I'm going to take you into the land of an Excel spreadsheet from SIFMA. These are outstanding bills, notes, and bonds from the U.S. Treasury. How much total debt is outstanding? The bills, of course, are the 1 month to 1 year maturities, the shortest on the yield curve. So all this money, $5.671 trillion, is due within a year, and most of it within 1 to 3 months. So this is the most ever that's been in the bills category. If we scroll up, you can see that the previous record was 2020 over here at 4.964, just about $5 trillion. That was during the lockdown period. And here we have $5.67 trillion. So point is, a lot of that is going to have to move over to the notes category to free up some space in the bills arena. And this has already been reported on, I think also by Bloomberg, might have been the FT. But I definitely did see an article that was telling that the Treasury is going to be selling less bills because there just aren't enough. There isn't enough room in the bills category to keep raising this amount of debt. They already have to pay back $5.67 trillion, like around the eye of a hurricane, a crazy Ponzi, where they use money from the bills category to pay back other bills, et cetera, et cetera. And so they're going to have to move about $2 trillion over from bills to notes, in addition to the $2 trillion noted by the Bloomberg article that they're going to have to raise. So that's about $4 trillion moved over into the notes category in a year. And those amount of dollars just don't exist unless the Fed prints them.
In the bills category, there's currently a substantial $5.67 trillion in debt due within a year. This figure marks the highest ever recorded in this category, surpassing the previous record of $4.96 trillion set in 2020. The noteworthy increase in short-term debt within the bills category signals a need for strategic financial management, potentially involving the redistribution of some of this debt to the notes category. Essentially, the surge in debt obligations in the bills category prompts a re-evaluation of the financial landscape. The need to possibly shift some of this debt to the notes category underscores the importance of adapting financial structures to maintain stability and manage increasing financial obligations.